All right, welcome to this explainer. Today, we are going way beyond the dense spreadsheets and typical financial jargon of Martin Marietta's second quarter 2026 earnings report. What we're actually going to uncover here is a massive narrative of corporate transformation. If you follow the building materials sector, you already know Martin Marietta is an absolute heavyweight. They provide the literal bedrock of our local highways, bridges, and communities. But what they've revealed in this quarter's release, it's nothing short of a strategic masterclass in reshaping a company for the future.
Let's just kick things off with the headline hook that pretty much caught everyone's attention right away. A staggering, record-shattering $1.947 billion in Q2 revenue. This isn't just some incremental little bump, you know? This is a definitive statement of absolute market dominance. Year over year, we're looking at a massive 21% jump from the $1.6 billion they reported back in the second quarter of 2025. This establishes their strength right out of the gate, and it's heavily driven by incredibly strong infrastructure and non-residential construction demand all across their footprint. So, here's our roadmap for today to help you separate the signal from all the accounting noise and truly grasp their long-term SOAR 2030 direction. We'll breeze through their record Q2 highlights, break down those major acquisitions, explore how they're unlocking internal efficiency, do a deep dive into specific business segments, and finally, look at their future outlook. Okay, diving right into Section 1, record Q2 highlights. Let's lay the groundwork by looking at the raw financial scorecard. Drilling into the financials, that incredible top-line growth is paired with a 13% jump in adjusted EBITDA from continuing operations, climbing to $638 million. This profitability growth is a direct result of both really strong organic performance and some incredibly smart acquisition contributions. When the infrastructure sector demands materials, Martin Marietta's business model proves time and time again its extraordinary earnings power and resilience. But beyond the raw financials, there's something CEO Ward Nye specifically called out that I really want to highlight. He noted that the team delivered the safest first half in the company's entire history. In an industry literally defined by heavy machinery and intense physical labor, bringing this human element to the forefront speaks volumes about their disciplined operational execution. Safety really is the bedrock of sustainable growth. Moving on to Section 2, major acquisitions. This is all about shaping the future portfolio, because they haven't just been selling rocks, they've been buying massive market share. Take June 27th, for example. They announced an absolutely monumental $13.5 billion agreement to acquire Loist North America, or LNA. Guys, this is a total game changer. It perfectly executes their SOAR 2030 strategy by vastly expanding their upstream specialties platform. So what does this actually mean in plain English? Well, it officially establishes Martin Marietta as the nation's leading producer of limestone products. They're bringing in a massive network of 20 quarries and 45 distribution terminals, basically locking down scarce, long-lived mineral reserves that are absolutely critical to future construction. And they didn't stop there. Couple that mammoth LNA deal with the May acquisition of New Frontier Materials, which is a strategic bolt-on business serving the greater St. Louis area, and you add over 8 million tons of aggregates annually right along the crucial I-70 corridor. Put these together, and you clearly see a company aggressively on the move, deepening its leadership position while expanding into highly differentiated specialty markets. So how do they fund all this? That brings us to Section 3, unlocking efficiency, the engine driving cash. Because massive growth requires a highly disciplined engine to run it. Through an expanded enterprise review, Martin Marietta's management identified a stunning $350 million in expected annualized cash flow improvements. That is a massive amount of capital to free up organically from right within their existing business. They're actively achieving this through 3 main operational steps. They're optimizing their rapidly evolving asset base, enhancing their network footprint, and strictly reducing sustaining capital requirements. And listen, this isn't just future talk. Through disciplined inventory management and reduced capital spending, they've already unlocked more than $200 million of cash year to date compared to last year. They are literally squeezing incredible efficiency out of their operations. All right, Section 4, segment deep dive. Let's look under the hood and see exactly how they made their money this quarter across their different product lines. Breaking down the regional powerhouses, the East Group drove a massive $972 million in revenue, while the West Group brought in $823 million. Their building materials business is fundamentally strong across the board, pushing overall aggregate shipments to a record 61.6 million tons. Now, what's really fascinating here is the stark contrast we see in the aggregates product line. Notice how revenue jumped 16%, which is fantastic, yet their gross profit actually dropped by 3%. On the surface, you're probably thinking, wait, that looks alarming. Why would you make more money but keep less of it? Well, the crucial point here is this accounting quirk, a $52 million non-cash inventory step-up charge. Basically, when Martin Marietta acquires a company, standard accounting rules require them to mark up the acquired inventory to fair market value. So when they actually sell that inventory, it looks like it costs more, which temporarily depresses the gross profit on paper. But remember, it's a non-cash charge. The actual shipment momentum and the underlying business remain incredibly strong. That drop is just a temporary artifact of their aggressive acquisition strategy. Meanwhile, if we look over at their specialties business, it was an absolute powerhouse. They hit record quarterly revenues of $152 million and jumped to $50 million in gross profit, which is up from $36 million a year ago. This was driven by organic pricing gains across all their products and a really strong contribution from a previous magnesia acquisition. It basically proves their strategy to expand this highly profitable upstream segment is paying off beautifully. Which leads us to Section 5. Future outlook. Looking at the road ahead, what does the landscape look like for the rest of 2026? Their strategic timeline shows incredibly rapid execution. I mean, just look at this year so far. An asset exchange in Q1, a major bolt-on acquisition in May, and a historic $13.5 billion agreement in June. This sets up a highly anticipated second half of the year when the LNA deal is actually expected to close, pending regulatory approvals. The sheer pace of value creation here is honestly staggering. Because of this tremendous momentum entering the year, management has confidently raised their full-year revenue guidance to a range of $7.2 billion to $7.4 billion and reaffirmed their adjusted EBITDA guidance. But here is the absolute most important takeaway. This raised guidance does not even include any upcoming contributions from the $13.5 billion LNA acquisition yet. The underlying organic business is just that strong on its own. And amidst all this aggressive growth, restructuring, and capital deployment, they remain highly dedicated to their shareholders. In just the first half of the year, they returned $302 million to investors. That's $200 million through share repurchases and $102 million in dividends. It's a really balanced approach of compounding shareholder value while aggressively funding future growth. Which leaves us with this final thought for today's explainer. Martin Marietta isn't just reporting numbers. They are actively rewriting their corporate DNA. As they seamlessly integrate these massive acquisitions and cement their foundation as the nation's leading limestone producer, how will this historic multi-billion-dollar reshaping alter the landscape of the physical infrastructure we rely on every single day? I mean, the concrete in our cities and the asphalt on our highways all trace back to decisions like these. It's a fascinating question, and one we are definitely going to be watching closely as 2026 unfolds. Thanks so much for joining me on this deep dive.